This is Barry Zalma on insurance. Today I'd like to speak about other insurance clauses. Every third-party liability policy contains an other insurance clause that attempts to control disputes when there are two or more policies insuring against the same risk of loss. Other insurance is used in a special sense in insurance contracts. It describes the situation where two or more policies of insurance cover the same risk of loss in the name of, or for the benefit of, the same person. Difficulties arise when two or more policies have other insurance clauses that conflict with each other, and the insurers and the insureds must find a way to resolve the conflicts. There are generally three types of other insurance clauses. First, the Pro-Rata Clause. Under a pro-rata other insurance clause, the insurer seeks to limit its liability to the proportion that its policy limits bears to the total coverage available to the insured. Second, the excess-only clause. Under an excess-only other insurance clause, if there is other valid and collectible insurance, the insurer is liable only to the extent the loss exceeds such other insurance. And third, the escape clause. Under an escape other insurance clause, the existence of other valid and collectible insurance extinguishes the insurer's liability to the extent of such other insurance. In many states, it is a type of crime of insurance fraud to present the same claim to two different insurers. The need for other insurance clauses arose when it was found that people would have more than one insurance policy covering the same risk by error, accident, or incompetence, rather than as part of an attempt to defraud an insurer. How the other insurance clause affects the insured is of primary importance to the insurance claims adjuster and the lawyer representing an insured or an insurer. The resolution of these conflicts has been the subject of a great deal of disputed claims and litigation between insurers and insureds. Multiple coverages for the same risk can occur when a claim is covered by concurrent policies. When an insured has a claim with more than one potentially applicable policy, courts determine the insurer's obligations to the insured by rules of construction and application made by the courts over the last several hundred years. The rules of insurance policy interpretation were developed to resolve multiple insurance disputes. Insurers have attempted to clarify their intent by rewriting other insurance clauses only to find the courts refuse to accept or otherwise modify the intent of the insurers when a dispute between insurers is brought to the court to determine which insurer pays what amount to which insured. Although there is some similarity to the old Abbott and Costello who's on first routine, in fact, rules and regulations are followed by the courts based upon rules of contract interpretation that have developed over the last several hundred years. The rights and obligations of co-insurers depend, usually, on the specific language of the insurance contracts, as long as they don't conflict. The general rule, when multiple policies share the same risk but have other inconsistent other insurance clauses, is to prorate according to the policy limits. Courts in other jurisdictions have taken different approaches, Most prominent among the alternatives is an allocation based upon time at risk, that is, the number of years an insurer covered a continuous loss. Other insurance clauses have been known to convert what the insurer and insured brought into existence as a primary policy into an excess policy. Courts, when working to resolve disputes concerning other insurance clauses, will work to order what will honor the intent of the parties and still provide a fair and good faith response to the claim in the best interests of the parties to the policies of insurance. Insurance purchased as primary coverage must respond to a covered claim before policies purchased as secondary coverage. This obligation exists regardless of the presence of other insurance clauses in the primary policies. Overlapping coverage for the same risk under concurrent policies are often found in three different contexts. First, by design. This may occur if, for example, the insured purchased a general umbrella catastrophe policy with specifically scheduled underlying coverages and also purchased multiple layered excess coverages over specifically scheduled primary or agreements to self-insure. These coverages and agreements can occasionally overlap when one insurer uses up its limits, and the excess or umbrella policies are required to drop down over a self-insured retention. Sometimes a person seeking to profit from an insurance claim will intentionally purchase multiple policies for first-party insuring agreements against the same risk of loss in an attempt to profit fraudulently from a claim. If discovered, the insured could face denial of all claims, criminal prosecution, or the insurers sharing pro rata in the payment of the claim. I handled one claim where a woman insured the same ring on a personal articles floater with 5 different insurers, reported it lost on a train ride, and then made claim to all 5 insurers for the full value of the ring. 4 of them paid. The last one, a member of the NICB and the ISO claims database, learned of the other 4 and denied the claim as being fraudulent. Eventually, the other 4 split or got returned their money from the insured criminal to avoid prosecution. Second, by coincidence. Overlapping coverage can occur if, for example, a landlord is named as an additional assured of his tenant's policy and maintains separate coverage for himself, or the non-owner driver of a vehicle is covered as a named insured under his own auto policy as well as under the permissive use clause of the vehicle owner's policy. Third, inadvertently. An inadvertent overlap may arise where there has been a switch from occurrence coverage to claims-made coverage, and a claim is made during the claims-made policy period on the basis of an act that took place during the occurrence policy period. The insured who inadvertently purchases a second policy while not realizing that the first policy had not been canceled, overlapping coverage for the same risk under consecutive policies may arise from injury or damage that spans more than one policy period. The various types of other insurance clauses can be specific. For example, the Pro-Rata Clause usually provides that if other insurance exists, the insurer will pay its pro-rata share of the loss. Payment is usually made in the proportion that the policy limit bears to the aggregate limit of all other valid and collectible insurance. The Pro-Rata Clause typically provides, quote, if the insured has other insurance against liability or loss covered by this policy, the company shall not be liable for a greater proportion of such liability or loss than the applicable limit of liability bears to the total applicable limit of liability of all collectible insurance against such liability or loss. Where the other insurance clause of each policy contains a pro rata provision stipulating that each shall bear a proportion of the loss to the extent of the applicable insurance, the policies are not mutually repugnant, and each carrier, each insurer, must bear its respective proportionate share of the loss. Kentucky law is well settled that when a policy containing a pro rata other insurance clause conflicts with a policy having an excess other insurance clause, the policy with the pro rata provision should be applied first, and the policy with the excess clause would become effective only when the first policy is exhausted. Long-tail claims present unique difficulties. In such cases, the injury-producing harm is gradual and continuous and typically spans multiple insurance policy periods or implicates years during which insurance coverage was in place as well as years for which no coverage was purchased. In general, two primary methods of allocation are used by the courts across the country to apportion liability across multiple policy periods. They are either all sums or proration. All sums allocation permits the insured to collect its total liability under any policy in effect during the periods that the damage occurred up to the policy limits. Pro-rata allocation, assuming complete coverage, an insurer's liability is limited to sums incurred by the insured during the policy period. In other words, each insurance policy is allocated a pro-rata share of the total loss representing the portion of the loss that occurred during the policy period. Pro-rata shares are often, although not exclusively, calculated based on an insurer's time on the risk, a fractional amount corresponding to the duration of the coverage provided by each insurer in relation to the total. When using a pro-rata time on the risk allocation, a number of jurisdictions have declined to place the policyholder on the risk if insurance was unavailable. These jurisdictions recognize the unavailability rule, or stated differently, an unavailability exception to the general rule that a policyholder is self-insured and on the risk for periods of time when insurance coverage was not obtained. This is the kind of decision that a court makes when it feels it is more like Solomon than a judge of American law and does what is fair to the insured and unfair to the insurer. When dealing with an excess clause that usually provide that an insurer's liability is limited to the amount by which the loss exceeds the coverage provided by all other valid and collectible insurance, up to the limits of the policy containing the excess clause, an excess clause is distinguishable from a pro-rata other insurance clause. The terms prorate and excess do not have and were not meant by the insurers to have identical meaning. A typical example of an excess clause reads as follows, quote, unless otherwise endorsed, this policy shall be excess over any other insurance, whether prior or subsequent hereto, and by whomsoever effected directly or indirectly, covering loss or damage insured hereunder, and this company shall be liable only for the excess of such loss or damage beyond the amount due from such other insurance, whether collectible or not, however not exceeding the limits set forth in the declarations." Close quote. This was a comment in the winter edition of the Circular Riddle and from Appleman Insurance Law and Practice, Section 4906. There are various other ways to deal with excess clauses, and you will find the detail, since as this video is only adapted from my book Zelma on Insurance Claims, Part 102, 3rd edition, which is available as both a Kindle book and a paperback from Amazon.com. If you found this video to be of interest to you or your colleagues, please pass it on. It's free. And please also subscribe to my Rumble channel, my YouTube channel, my blog, and my Substack publications so that you can learn about future videos and future blog postings. Thank you for your attention.